Hey guys, welcome back to the channel. In today's video, I'll be sharing with you my review and summary of the book Think and Trade Like a Champion by Mark Minervini. Mark Minervini is a legend in trading circles, and his book Think and Trade Like a Champion is probably one of the best books out there on trading. So in today's video, I'll be sharing with you some of the lessons that I learned from Mark Minervini's book Think and Trade Like a Champion and how you can use them in your own investing and trading in the stock market. If you want to have actionable and implementable steps to take your investing and trading to the next level, make sure you stick around in this video so that you don't miss out on any of these valuable tips that I'll be sharing with you. For those of you who are not too sure who Mark Minervini is, Mark Minervini managed to generate an average of 220% returns per year for more than 5 years. That totaled to 33,500% returns over those 5 years. And to give you some context, with that kind of returns in the stock market, a $100,000 account would turn to more than $30 million in just 5 years. That's an insane amount of returns in the stock market. And the kind of performance in the stock market is what we call super performance. Mark Minervini also ranked number 1 in the 1997 US Investing Championship trading stocks alone without any leverage. Even while some of its competitors were using massive leverage, Mark also managed to turn his personal trading account from a few $1,000s to a few $1,000,000. It's easy to see why Mark Minervini is considered one of the best traders out there. So in this video, we'll be taking a look at the lessons that Mark Minervini shares in his book Think and Trade Like a Champion. The first lesson that Mark Minervini shares is how to generate big performance in the stock market. After generating big returns in the stock market on a consistent basis, Mark Minervini breaks down the 4 keys in generating super performance in the stock market. The 4 keys are timing, don't over-diversify, and turnover is not necessarily bad, and always maintain a favorable risk to reward ratio. Now, let's take a look at the first key in generating big performance in the stock market. Mark Minervini believes that in order to generate big returns in the stock market, we must compound our money rapidly. Mark Minervini uses this example to show us how compounding our money rapidly can allow us to generate big returns in the stock market. If we make 2 trades back to back and the percentage return on each trade is 40%, then our total compounded returns will be 96%. If we make 4 trades back to back and the percentage returns on each trade is 20% instead of 40%, our total compounded returns will be 107%. However, if we make 12 back-to-back trades instead, and the percentage return on each trade is only 10% now, the total compounded returns for those 12 trades will now be 214%. What Mark Minervini was trying to show us in this example is that even though the percentage returns on each trade might be lower, say 10% versus 40% on each trade, if we are able to compound the 10% trades more rapidly, in this case 12 trades for the 10% returns versus the 2 trades for the 40% returns, the total compounded returns for the 12 trades at 10% each will be higher than the total compounded returns for the 2 trades at 40% each. So Mark Minervini shows us that if we can compound our money rapidly, we are able to generate huge returns in the stock market. The next key is not to over-diversify. The huge caveat is this: don't over-diversify only if you have a significant edge in the stock market. If you don't have a significant edge in the stock market, then this advice might not apply to you. But if you do have a significant edge in the stock market, then over-diversification doesn't help you. It actually dilutes you. And Mark Minervini believes that in order to generate big returns consistently, we need to be concentrated among the very best names. Sure, if the market is doing well, diversification can help you generate substantial returns in the stock market, as more stocks will be rising. However, when the market is not doing so well, not all stocks will perform well. And that is when over-diversification can hurt your returns in the stock market, right? So if you want to generate big returns in the stock market consistently, you need to be concentrated among the very best names. 4 to 12 stocks are a good number to manage in your own portfolio. Anything more than 12 means that you're not concentrated among the very best names. Mark Minervini also pointed out this very important point. When he mentions being concentrated among the very best names, he means that concentrated at the right time and not all the time. He doesn't believe in loading up on stocks and trading aggressively all the time. He only trades aggressively and is concentrated among the very best names at the correct time. And that is the second key to generating big performance in the stock market. Don't over-diversify. The third key is turnover. Mark Minervini believes that if you have an edge and a concentrated portfolio, turnover can be good. Note how he attached a condition again to his advice. The condition is to have an edge in the stock market and a concentrated portfolio. When these conditions are met, then turnover can be good. Mark Minervini believes that money should always be moving to where you are going to reap the best performance and moving out of situations which put your capital at risk. Furthermore, as we have learned earlier on, trading in and out of positions can potentially compound your money more rapidly, especially if you have an edge in the stock market. So if we compare the number of trades, 2 trades versus 12 trades, the total compounded returns for the 12 trades is higher than the total compounded returns for the 2 trades, even though the percentage returns on each trade for the 2 trades is higher at 40% compared to the percentage returns on each trade for the 12 trades at 10%. That is why Mark Minervini believes that turnover can be good if you have an edge in the stock market. The next key to generating big performance in the stock market is to have a favorable risk to reward ratio. Mark Minervini believes that we should always maintain the risk to reward ratio. And that leads us to the second lesson. The second lesson from the book Think and Trade Like a Champion is to take into account the risk to reward ratio. Mark mentioned that just because your gains are larger than your losses, it doesn't necessarily mean that you'll make money, even if your wins are twice as large as your losses. Minervini points out that your percentage win rate or your betting average also matters. This table shows a risk to reward ratio of 1:2, but under different circumstances. It shows the 1:2 risk to reward ratio under different percentage gains, different percentage losses, and under different betting averages or win rate. So if we take a look at the last example here, the risk to reward is 1:2. And we get this risk to reward ratio by taking the percentage loss against the percentage gain. So 50% against 100%. So that gives us a risk to reward of 1:2. So even though we have a risk to reward ratio of 1:2, we are losing money at a 40% betting average or a 40% win rate. And that is because losses work geometrically against us. On top of paying attention to the risk to reward ratio, we should also pay attention to the absolute percentage gains and percentage losses and our betting averages or win rate. So even though the risk to reward ratio might be the same, but because the absolute percentage gains and the absolute percentage losses are different, we can get different results in the stock market. Because with increasing losses in proportion to our gains, the returns that we generate actually declines. The third lesson that I learned from Mark Minervini's book, Think and Trade Like a Champion, is to measure our performance in the stock market. Because what gets measured gets managed. Mark Minervini recommends keeping a spreadsheet on our every trade. Some of the things he recommends us to keep track of are our average gains, our average losses, and our percentage of winning trades. This is an example of how Mark Minervini keeps track of his trades. Some of the things he keeps track of are his winning percentage, average gains, and average losses. The winning percentage corresponds to the betting averages, the average gain corresponds to the percentage gains, and then the average loss corresponds to the percentage loss. Once we have tracked these three key data, we are able to fine-tune our performance in the stock market. For example, if our winning percentage or betting average is at 50%, and our percentage loss is on average 6%, and our percentage gain is on average 12%, then we know our returns in the stock market is around 29.34%. And with the same winning percentage and betting average at 50%, we can increase our returns in the stock market by taking more risk and increasing our returns in the stock market. So if we increase our risk to 7% instead of 6%, and if we increase our returns from 12% to 14%, we are able to generate a higher returns in the stock market. So by measuring our performance, we know the areas we can tweak in order to increase our returns in the stock market. The fourth lesson is to avoid large drawdowns. Mark Minervini points out that we won't achieve super performance if our profits get eaten up by large drawdowns. And he wants to get rid of the myth that we can't have big profits without taking big risks. Mark Minervini believes that such thinking is wrong. Instead, when he is trading in the stock market, he's looking to take small risks in return for big potential rewards. This also ties back to the earlier point that we always want to maintain a favorable risk to reward ratio. And that is the path to being profitable and successful in the stock market by taking small risks in return for big potential rewards. The fifth lesson is to protect our capital. He wants us to protect our break-even point once we have generated some profits. The break-even point is the point where we entered our position in the stock market. So once the stock has moved up a fair bit, and if we move our stop loss to our entry point, that is the point where we break even. Because if prices move to our new stop loss point, we won't lose any of our money because that is also our entry point. And that is why we call it the break-even point. And by protecting our break-even point, we are not risking any of our capital. And that is how we avoid large drawdowns. And as we have learned earlier, large drawdowns to our capital is detrimental to our success and profitability as a trader in the stock market. So Mark Minervini believes in using stop losses to protect our profits and to also minimize our losses. I have a video on stop losses which you can check out over here, where I share with you in greater detail on what stop losses are and how to set stop losses in the stock market. Let me show you an example of how we can use stop losses to protect our break-even point. Say we enter our position in the stock market at this point over here. So this is our entry point. And when we enter our buy position in the stock market, we also want to set our stop losses. So our stop loss will be at around this point over here. Say the price of the stock moves up a bit, but we don't want to move our stop loss just yet, because it hasn't moved up far enough yet for us to move up our stop loss. After that, we see a natural retracement of the stock to this point over here. And after that, the stock rallies again and move up to this point over here. So when the stock moves up to this point over here, we can shift our stop loss to this point over here, which is the break-even point. So if we move our stop loss to that price level, we do not lose any of our money or our capital when our stop loss is hit. As prices continue to rise, we can continue to move our stop losses up. And that is the 5th lesson that I learned from Mark Minervini's book, Think and Trade Like a Champion. If you have learned something from this video, smash that like button because it will really help the channel grow and allow me to produce more content such as this. And if you have any questions about this video, drop them down in the comments below and I'll make sure to answer them. And one last thing, if you haven't already subscribed to my channel, make sure you subscribe to my channel so that you don't miss out on future videos such as this where I share on investing, trading and the stock market. I'll see you in those other videos. To your financial success.